Good morning, everyone. Last night, FMC announced our fourth quarter and full year 2025 results, as well as our 2026 priorities. Importantly, we also announced that our board of directors has authorized exploring strategic options, including but not limited to a potential sale of the company. To strengthen our business and position ourselves for success, we are laser-focused on executing our operational priorities in 2026. Those include strengthening the balance sheet, improving the competitiveness of our core portfolio, managing our post-patent Rynaxypyr strategy, and driving growth over new active ingredients. In parallel, the company is working to evaluate the best path forward for the benefit of the business and to maximize shareholder value. Accordingly, the board of directors has decided that a formal proactive process to evaluate strategic options makes sense to undertake at this time. The strategic review is at a preliminary stage. We have retained financial and legal advisors to assist us with this process. This strategic review does not impact the process underway to sell our India commercial business. As we look ahead, we are committed to position FMC for long-term success, and that starts with working toward our 2026 priorities as laid out on slide 4. To strengthen our balance sheet, we are targeting paying down over $1 billion of debt through asset sales and licensing agreements. This includes the sale of our India commercial business, which continues to progress with binding bids expected to be received in the second quarter. In addition, we are in active discussions regarding licensing agreements, which include upfront payments. Increasing the competitiveness of our off-patent portfolio product remains a top priority. Our goal is to lower the cost of non-diamide products to more effectively compete against generics. 2025 sales of these core products, excluding Rynaxypyr, were approximately $2.2 billion. Nearly $1 billion of these sales came from products manufactured in high-cost facilities. We expect to lower the manufacturing cost of these products by at least 35% by 2027. This is a complex process which will require re-registration for most products, as well as a build-up of inventory in advance of the transition. As a result, we will be limited in our ability to adapt to manufacturing mix to the changing needs of our customers. We believe this reduced flexibility will act as a sales headwind in 2026 and has been reflected in our forward guidance. In addition, we are executing a post-patent strategy for Rynaxypyr. 2025 sales were just over $800 million and in line with our expectation. Beginning 2026, there will be generic offerings of CTPR in all markets. As CTPR becomes more widely available through generics, resistance is likely to increase. For example, we are seeing pest resistance in rice crops in China and Japan. Our advanced formulations and mixture are designed to address this challenge. As the owner of the original molecule, we have years of historical proprietary data which benefit our development of formulations and mixtures to combat resistance. For our more basic formulations of Rynaxypyr, our plan remains to lower price and grow volume by capturing market share from all the classes of insecticides. We are already observing success with this strategy in a number of countries. We anticipate branded Rynaxypyr earnings dollars in 2026 to be in line with prior year as higher volume, particularly for more advanced offerings, and lower costs offset lower price. Finally, we are committed to the continued sales growth of our 4 new active ingredients. We are only in the early stages of sales for our 4 new molecules, but we are already seeing solid growth. Sales have increased from approximately $130 million in 2024 to approximately $200 million in 2025. Those sales are almost entirely driven by fluindapyr and Isoflex. Dodhylex received emergency registration in 2 countries, which resulted in modest sales in 2025. While sales of new active ingredients grew 54% in 2025, they were below our expectations of $250 million. This was mainly due to impacts from later than expected registration for Isoflex in Great Britain. We estimate 2026 sales for new active ingredients to be between $300 million and $400 million. These actives are in high demand, with 3 of them offering a new mode of action. We still expect sales of the 4 actives to exceed $2 billion by 2035. We believe executing these priorities position us to enter 2027 with a stronger balance sheet, a more competitive portfolio, and growing sales of higher margin differentiated products. Our 2026 full year guidance is provided on slide 5. We're expecting full year sales of $3.6 billion to $3.8 billion to be down 5% at the midpoint versus prior year. Price is expected to be a mid-single digit headwind driven by Rynaxypyr, which is consistent with our post-patent strategy. The removal of India is expected to be a 2% full year headwind that will only impact the first half. Excluding India, we expect volume to be modestly higher, driven by new actives and branded Rynaxypyr. Full year adjusted EBITDA is expected to be between $670 million to $730 million. As you can see on slide 6, the main headwind versus prior is in our legacy portfolio due to competitiveness. Rynaxypyr overall is expected to decline, driven by diamide partner sales. It is important to note that branded Rynaxypyr earnings are expected to be in line with prior year as we implement our strategy. Tariffs are expected to be a $20 million headwind, nearly all of which will impact first quarter results. We expect positive impact from a growth portfolio with particularly strong contribution from new active ingredients. Our first quarter sales guidance, outlined on slide 7, is $725 million to $775 million, 5% lower than prior year. Price is expected to be lower by mid-single digit, which is consistent with our expectation for all quarters this year. The removal of India represents an additional 5% headwind. We do expect some volume growth as modest increases across most regions are largely offset by a few significant factors. There have been a large number of generic CTPR offerings announced, particularly in the US and Brazil, as the last other patents expired at year-end. Distributors and retailers have been reluctant to fully stock Rynaxypyr until they better understand the quality, availability, and grower response to these generic offerings. We believe generic entry is also impacting our diamide partners, from whom we are expecting lower orders in the first quarter. Finally, planned registration losses in Europe will impact volume growth. We expect adjusted EBITDA to be between $45 million and $50 million, which is 58% lower than prior year and represents about half of the total EBITDA net headwind we expect for the year. The expected EBITDA reduction is largely due to lower price as well as cost factors that are unique to Q1. For example, manufacturing costs are unfavorable to prior year in the first quarter, but as the year progresses, manufacturing costs are forecasted to become favorable. In addition, the full year $20 million tariff charges are recorded almost entirely in Q1. EBITDA margin in the first quarter is expected to be around 7%. This abnormally low margin is caused by the combination of lower sales on which to absorb relatively flat fixed cost and the unique cost headwind I just noted. We expect this margin profile to be unique to Q1, with subsequent quarter margins returning to more normal levels as a result of higher sales and favorable manufacturing costs. I will now turn the call over to Andrew.
Thanks, Pierre. I'll start this morning with a brief overview of our fourth quarter results. Let me note that you can find more detailed description of our fourth quarter and full year 2025 results on slides 12 through 18 of today's presentation. During the fourth quarter, we continued to operate in challenging market conditions, including intense competition from generics and weaker grower margins. These conditions affected the timing of purchases and product mix for crop protection. While we delivered adjusted EBITDA and adjusted EPS near our guidance midpoints, sales came in below our guidance range. We reported $1.08 billion in Q4 sales, a decline of 11% year over year, or 5% on a like-for-like basis, excluding India. Price declined 6%, driven by lower Rynaxypyr and strong market competition, particularly in Latin America, which led to pricing headwinds for our core portfolio products. Volumes were weaker than anticipated, with a decline of 1% due to high competitive pressure. Fourth quarter adjusted EBITDA was $280 million, a decline of 17% versus the prior year quarter, down 8% on a like-for-like basis, excluding India from the prior year. Lower price and volume were partially offset by lower costs and FX. Adjusted earnings per share for the quarter was $1.20, a 33% decline due to lower adjusted EBITDA and higher interest. Moving on to free cash flow and the balance sheet. We reported GAAP cash from operations of $657 million for the fourth quarter, up $230 million versus the prior year period. The increase was driven by a release of working capital, particularly from receivables. This led to free cash flow of $623 million for the quarter. We ended 2025 with cash from operations of negative $6 million, which included $103 million of cash restructuring spending. 2025 free cash flow was negative $165 million. We ended the fourth quarter with net debt of approximately $3.5 billion, down over $550 million from the third quarter due to strong free cash flow. Net debt to trailing 12-month EBITDA was 4.1 times at year-end, while covenant leverage was 4.6 times. As a reminder, our covenant limit is 6 times through the third quarter of 2026, and then steps down to 5.5 times at year-end. Turning to slide 8 and that cash flow outlook for 2026. Free cash flow for 2026 is expected to be in the range of negative $65 million to positive $65 million, or break even at the midpoint, including an expected $130 million in restructuring spending. Lower EBITDA, higher restructuring spending, and modestly higher capital expense are expected to be offset by the liquidation of India working capital, lower cash taxes, and improved working capital performance in the ongoing business. Despite break-even free cash flow and lower EBITDA, with the successful execution of our debt paydown plan, we expect to end 2026 with a reduction in net leverage of approximately 0.5 turn. We would then expect leverage to further improve in subsequent years with higher free cash flow from growing EBITDA and reduced restructuring spending. With that, I'll hand the call back to Pierre.
As we look ahead, the key driver of our growth and what differentiates us from the majority of other crop chemical providers is our R&D pipeline of new active ingredients. This pipeline is a result of years of dedicated work by our research and development teams, and it represents a significant competitive advantage for FMC. On slide 9, we have provided base sales expectation using the current targeted crops. But we believe there is substantial upside to sales through application on additional crops. Fluindapyr fungicide has been registered and launched in all major countries where we intend to sell, including the US and Brazil. Going forward, the focus will be on expanding sales through continued grower education. For Isoflex active, we are already registered and selling in a number of countries. Sales are expected to increase in 2026, in particular due to a full growing season of sales in Great Britain following a delayed registration in 2025. Further growth is expected in 2027 following product registration in the EU. We remain on track to receive these important registrations as we recently received approval for the active ingredient last week. Dodhylex active is the first new mode of action herbicide in over 30 years. We are confident that this herbicide can be useful in other crops like sugarcane and expect meaningful contribution from Dodhylex beginning in 2027. Finally, rimisoxafen is expected to begin receiving registration in 2028. Rimisoxafen is the first herbicide ever to be classified as a dual mode of action. It is primarily targeted with Palmer amaranth and is now resistant to 8 herbicide classes. This pre-emergent herbicide will offer corn and soybean growers a new solution to an increasingly challenging problem. In addition to these 4 molecules, we have 2 more active ingredients in development. While we expect sales of these 2 active to begin during the early 2030s, their contribution is not included in the $2 billion of expected 2035 sales listed in the slide. The growth of these active ingredients are an important part of our key dynamics for 2027 and 2028, which are outlined on slide 10. In addition to accelerating the growth of a new active, it is important for us to also stabilize our core portfolio by executing a Rynaxypyr post-patent strategy and by improving the competitiveness of our legacy core. We expect margins to improve with SG&A and R&D spend growing much slower than top-line sales. The combination of these actions is expected to result in EBITDA growth in the mid-teens % in both 2027 and 2028. In closing, we are committed to position FMC for long-term success. Our teams across the company are focused on executing our operational priorities with the same dedication and innovation that has always defined FMC. At the same time, we are undertaking a process to explore strategic alternatives. We believe that pursuing both paths simultaneously best position us to maximize value for shareholders.